A bit of post-Easter blues quickly gave way to a full-on battering for the Big Four, dragging the whole market lower. ANZ fell heavily again today, with billions of dollars wiped off its market value in just 2 trading days. The others didn't fare much better, all are down sharply. And joining me now to discuss the latest round of market bank bashing is fund manager Roger Montgomery. And Roger, quite a stampede out of the banks today.
Well, there is a feeling that that this is the tip of the iceberg, that ANZ's reporting of $800 million of bad and doubtful debts for the first half back in February, and this $100 million added to it is just the beginning of something. And inevitably, humans are very, very bad at picking turning points. Of course, the
big question is it systemic, presumably?
Indeed. Well, at the moment it doesn't appear to be. The 800 million was related to Indonesia for ANZ. The 100 million is related, it's believed, to oil and gas, and particularly Arium in Australia and Peabody. But the banks are reporting that that they're seeing an uptick in their 90-day arrears on their consumer loans and mortgages. They're in the case of ANZ, they're cutting overheads and cutting staff costs by 2.5%. So there's pressure on the banks from a credit growth perspective, and where growth is absent, then high share prices that have been chased for their yield, if they're not supported by fundamentals, particularly earnings growth, then they're inevitably going to mean revert. They're going to come back.
We've had these record profits, of course, with the Big Four banks, and they were all driven by record low debt provisions. Now,
yes.
What happens to those profits?
So precisely at the time that that banks had been writing back their bad and doubtful debt loan provisions to boost profits, so that, if you like, the tank is empty, so to speak. It's precisely at a high point in the cycle for property. So I think what investors are really nervous about is whether or not an oversupply of property, which is what we're going to be seeing shortly, and we can go through those numbers in a minute. If those numbers do result in a slowing of property credit growth, then what does that mean for growth overall, and are we paying too much for the banks?
Well, indeed. Now, the banks seem to report at different times. I think the half-yearlies for ANZ, NAB and Westpac are coming up next month.
Indeed.
But each of the banks seems to be sort of more geared to different areas. I know Commonwealth Bank is very much into the housing loan market, isn't it? What is happening there with housing?
And so ANZ really, we're all interested in what's going on with Asia. They're pulling back from Asia, and particularly the low margin business in Asia. So you would expect to see net interest margins increase for the ANZ, but what they've reported is that funding costs are going up as well. So that's an issue. For the NAB, you've got their business book, but really, for me, the 3 banks, and I'm excluding the NAB from the big 3. You have the big 3 and then you have the NAB, and that's because they've destroyed so much value over the last 10 years, and so it's probably quite a surprise to people to see that the share price of the NAB is actually lower than where it was in 1999, and they've added no growth, they've added no value over that period of time. They had the Homeside debacle in 2001 where they lost $3 billion and so forth. So the big issue today, though, is all about property. It's all about whether or not we're going to see a problem on the property and the mortgage book for the banks.
And what's happening on the supply side there?
Well, what we've got is a very simple picture. We've got an oversupply of property. We are constructing something like 56,000 properties dwellings a quarter, and that amounts to about 224,000 a year, which is about 75,000 more than what we require for household formation in Australia, which is about 150,000 a year at the moment. So we are already about a year. We have a year of oversupply, and we're currently constructing another 50% more than we need. What is going to result from that? One of 2 things: either credit growth slows, and that means earnings growth for the banks slows, yes, and they're not able to lend as much, or supply continues to increase and we have a serious correction on our hands in the property market, and that means bad and doubtful debts go up. So they're between a rock and a hard place.
Soft question to end with: cultural issues, financial planning, ComInsure, BBSW, all these dramas. Is that going to impact on whether investors, briefly now, investors would like to go on and trust in investing in banks?
Well, we know banks need to be more efficient with their capital because they're now required to have more capital, and they can't lend as much for every dollar of capital that they've got. I'm going to put my head on the block and suggest that they might spin these businesses off in the future.
Roger Montgomery, thank you very much for joining us.
It's a pleasure.